October 1907. On the streets of New York City, thousands of people were running to their banks, desperate to withdraw their money before it was too late. Inside the financial district, panic was spreading like wildfire. Banks were collapsing, investors were losing fortunes overnight, and the entire American financial system was on the brink of disaster. There was no central bank, no safety net, no government rescue plan. The fate of the economy would soon depend on one powerful man, J.P. Morgan. This is the story of the Panic of 1907, the financial crisis that shook Wall Street and changed American banking forever. At the beginning of the 20th century, the United States stood at the peak of a remarkable transformation. Only a few decades earlier, the nation had emerged from the devastation of the Civil War. Much of the country was still rural, its economy rooted in farms and small local markets. But by the early 1900s, America had changed dramatically. Railroads stretched across the continent. Factories filled growing cities with the sound of machinery. Steel mills, oil refineries, and financial institutions were producing wealth on a scale the nation had never seen before. Industrial leaders such as John D. Rockefeller in oil, Andrew Carnegie in steel, and powerful financiers like J.P. Morgan had helped build an economic system that connected industries, banks, and markets across the country. For many Americans, the future appeared limitless. Investors poured money into railroads, mining companies, and new industrial ventures. Banks extended credit freely. The stock market rose steadily, and confidence in the nation's economic power seemed unshakable. Cities like New York became global financial centers, where fortunes were made in boardrooms and on trading floors. Yet beneath this atmosphere of prosperity, the financial system had a serious weakness. The United States did not yet have a central bank. Banking regulations were limited, and financial institutions were deeply interconnected. Confidence, the belief that banks and markets were stable, held the entire system together. And confidence, as history would soon reveal, could disappear very quickly. In the autumn of 1907, a sudden loss of trust would send shockwaves through the financial world. Banks would panic, markets would collapse, and the nation would confront one of the most dramatic financial crises of the early 20th century. This moment would become known as the Panic of 1907, a crisis that shook Wall Street, threatened the entire American economy, and ultimately changed how the United States managed its financial system. America's fragile financial system. To understand why the crisis of 1907 became so dangerous, we must first understand how the American financial system worked at the time. At the start of the 20th century, the United States had become one of the largest economies in the world. Industry was expanding rapidly, railroads connected distant regions, and international trade was growing every year. But the financial system supporting this enormous economic machine remained surprisingly unstable. Unlike many European nations, the United States did not have a central bank that could stabilize the economy during times of crisis. Earlier in the nation's history, institutions like the First Bank of the United States and the Second Bank of the United States had played that role. However, political opposition led to their disappearance in the early 19th century, leaving the country without a central authority to oversee banking. By the early 1900s, thousands of independent banks operated across the country. Many were small local institutions that depended heavily on deposits from businesses and ordinary citizens. If depositors suddenly demanded their money at the same time, most banks simply did not have enough cash on hand to pay everyone. This vulnerability created the possibility of what economists call a bank run, a situation in which frightened depositors rushed to withdraw their money, fearing that the bank might collapse. Ironically, the panic itself could cause the very failure people were trying to avoid. Another important part of the financial system was a group of institutions known as trust companies. These organizations were originally created to manage estates and investments for wealthy clients. But by the early 20th century, many trust companies had expanded into banking-like activities, accepting deposits and making loans. Unlike traditional banks, trust companies were less regulated and often kept smaller reserves of cash. Yet they handled enormous amounts of money, particularly in financial centers like New York. Their rapid growth made the financial system more profitable, but also far more fragile. At the center of all this activity stood Wall Street in New York City, the heart of American finance. Banks, investment houses, and trust companies were tightly connected through loans, investments, and stock market speculation. Money moved constantly between these institutions, creating a complex web of financial relationships. In prosperous times, this interconnected system helped fuel extraordinary economic growth. But it also meant that trouble in one part of the system could spread rapidly to others. If confidence in even a single institution collapsed, fear could spread through the entire financial network. And in 1907, that is exactly what would happen. A risky financial scheme, combined with declining confidence in key institutions, would ignite a chain reaction that threatened the stability of the entire American economy. The dangerous world of stock speculation. By the early 20th century, the American stock market had become one of the most powerful engines of wealth in the country. Investors from across the nation, and even from overseas, were drawn to the financial district of Wall Street in New York City, hoping to profit from the rapid growth of American industry. Stocks represented ownership in companies such as railroads, mining firms, steel producers, and manufacturing businesses. As these industries expanded, the value of their shares often rose dramatically. For investors, buying stocks seemed like a way to participate directly in the country's economic boom. But alongside legitimate investment, another activity was becoming increasingly common: speculation. Speculation involved buying stocks not because of a company's long-term success, but because investors believed the price would quickly rise. Many traders hoped to buy shares one day and sell them for a profit just days or even hours later. This approach could generate enormous profits. However, it also introduced a great deal of risk into the financial system. One of the most common methods used by speculators was known as buying on margin. Instead of paying the full price for a stock, investors could borrow most of the money needed to purchase shares. They would provide only a small portion of the cost themselves, while the rest was financed through loans from banks or brokerage houses. If the stock price increased, the investor could sell the shares, repay the loan, and keep the profit. But if the price fell, the losses could be severe. In some cases, investors could lose far more money than they had originally invested. Because borrowed money was fueling so much speculation, the stock market became deeply connected to the banking system. Banks and trust companies were lending large sums to traders who were gambling on rising stock prices. This meant that problems in the stock market could quickly spread into the banking system itself. Another dangerous practice involved attempts to manipulate stock prices. Wealthy investors sometimes tried to control the supply of shares in a company, a tactic known as cornering the market. If they could secretly buy up most of the available stock, they could drive prices sharply upward and force other traders to buy at inflated prices. These schemes were risky and often unstable. If the attempt failed, investors could lose enormous amounts of money in a very short time. In October of 1907, one such attempt would set off a chain reaction that would shake the entire financial system. A group of speculators would try to corner the stock of a copper company. The plan would collapse almost immediately, but the consequences would be far greater than anyone expected. Within days, fear would spread across the financial world, and the crisis known as the Panic of 1907 would begin. The collapse of trust companies. The financial panic of 1907 did not begin with the failure of a large bank. Instead, it began with a crisis of confidence surrounding a group of institutions known as trust companies. At the time, trust companies had become an important part of the American financial system. Originally, they had been created to manage estates and financial assets for wealthy families. Over time, however, many of them expanded their activities. They began accepting deposits, issuing loans, and investing heavily in stocks and other financial ventures. By the early 20th century, several trust companies in New York City had grown into powerful financial institutions. In fact, some of them held deposits comparable to the largest banks in the country. But there was an important difference. Unlike traditional banks, trust companies operated under much looser regulations. They were not required to keep as large a reserve of cash on hand, and they often invested depositors' money in riskier ventures. During years of economic growth, this approach allowed them to earn large profits, yet it also made them dangerously vulnerable if confidence in the financial system began to weaken. The crisis began in October 1907, when a group of speculators attempted to corner the stock of the United Copper Company. The plan quickly failed, and the price of the stock collapsed. One of the men involved in the scheme was connected to the leadership of the Knickerbocker Trust Company, one of the largest trust companies in New York. When this connection became public, it triggered immediate alarm among depositors. Rumors spread rapidly throughout the financial district. If a major trust company had been involved in a failed speculation scheme, people began to wonder whether their deposits were safe. Within hours, frightened customers began rushing to withdraw their money from Knickerbocker Trust. This was the beginning of a bank run. Crowds gathered outside the company's headquarters, demanding their funds. Inside, employees struggled to keep up as depositors withdrew millions of dollars in cash. The situation worsened when the powerful financier J.P. Morgan and other leading bankers refused to provide emergency support to Knickerbocker Trust. Without that assistance, the company could not survive the sudden wave of withdrawals. On October 22, 1907, the Knickerbocker Trust Company was forced to suspend operations. News of its collapse spread instantly across the financial world. If one of the largest trust companies in New York could fail so suddenly, many Americans feared that other institutions might collapse as well. Panic spread to other trust companies and banks as depositors rushed to withdraw their savings before it was too late. Within days, the crisis was no longer confined to a single company. It had become a nationwide financial panic, one that threatened to bring the entire American banking system to the edge of collapse. The bank runs. Once the collapse of the Knickerbocker Trust Company became public in October 1907, fear spread quickly through the financial community of New York City. What had begun as a crisis at a single institution now threatened to become something far larger. In the world of banking, confidence is everything. Banks and trust companies do not keep all of their depositors' money stored in their vaults. Instead, much of that money is loaned out to businesses, investors, and borrowers. As long as only a small number of people withdraw their funds at any given time, the system works smoothly. But if large numbers of depositors suddenly demand their money at once, even a healthy institution can quickly run out of cash. This is what economists call a bank run. After the failure of Knickerbocker Trust, depositors began to question whether other trust companies might also be in danger. Rumors circulated rapidly through newspapers, financial markets, and everyday conversations across the city. Within hours, anxious crowds began gathering outside banks and trust companies. People stood in long lines that stretched down city blocks, waiting for their turn at the teller's window. Some carried bank books and withdrawal slips. Others simply demanded their entire savings in cash. For many families, these deposits represented years of hard work and sacrifice. The fear of losing everything drove thousands of people to withdraw their money as quickly as possible. Inside the banks, the situation grew increasingly tense. Clerks counted out stacks of currency as fast as they could. Messengers rushed between institutions carrying bags of cash. Managers anxiously watched their reserves shrink hour by hour. The panic soon spread beyond trust companies. Even well-established banks began experiencing heavy withdrawals. Institutions that had been considered safe only days earlier now faced the terrifying possibility that they might run out of money. The crisis extended beyond New York. Financial markets across the country reacted immediately. Banks in other cities began limiting withdrawals, while businesses found it increasingly difficult to obtain credit. The American economy was beginning to freeze. Factories struggled to pay workers, merchants worried about meeting payroll. Investors rushed to sell stocks, driving prices sharply downward on Wall Street. Without decisive action, the entire financial system could collapse. At this critical moment, attention turned to one man whose influence in American finance was unmatched, the powerful banker J.P. Morgan. In the absence of a central bank, Morgan would step forward to coordinate a rescue effort that might determine whether the nation's financial system survived the panic of 1907. The man who tried to save the system. As the panic spread across the financial system in October 1907, the United States faced a dangerous problem. The country had no central bank to stabilize the situation. There was no national authority capable of quickly injecting money into struggling banks or restoring public confidence. In this moment of uncertainty, attention turned to one of the most powerful figures in American finance, J.P. Morgan. By 1907, Morgan was already a legendary figure on Wall Street. For decades, he had helped organize large corporations, stabilize troubled railroads, and finance major industrial mergers. Many bankers and investors believed that if anyone could prevent the financial system from collapsing, it was him. Morgan was 70 years old when the crisis began, but his influence remained enormous. As the panic intensified, he began gathering leading bankers and financial leaders at his private library in New York City. Inside that library, late into the night, meetings took place that would determine the fate of the American financial system. Morgan carefully studied the balance sheets of struggling banks and trust companies. He wanted to know which institutions could still be saved and which ones were already beyond rescue. His goal was not simply to protect individual banks, but to prevent fear from spreading further through the economy. One by one, Morgan and his associates began organizing emergency financial support. Groups of wealthy bankers were persuaded, and sometimes pressured, to contribute millions of dollars to stabilize threatened institutions. Morgan understood that restoring public confidence was essential. If depositors believed the banks would survive, the panic might stop. One of the most critical moments came when Morgan and his allies agreed to provide support for the Trust Company of America, another major financial institution facing a devastating bank run. Lines of worried depositors stretched outside its offices as rumors of collapse circulated. Morgan's intervention helped convince the public that the company would remain solvent. Slowly, confidence began to return. At the same time, Morgan worked with officials from the U.S. Treasury to inject additional money into the financial system. Government funds were deposited into banks to increase their reserves and reassure depositors that cash would remain available. Perhaps the most dramatic moment came when Morgan locked several leading bankers inside his library and refused to let them leave until they agreed to contribute funds to support the failing financial system. Facing the possibility of nationwide economic collapse, they eventually agreed. Through these coordinated efforts, Morgan and the financial community were able to stop the worst of the panic. Gradually, the long lines outside banks began to disappear. Depositors stopped withdrawing their savings. The stock market stabilized, and the immediate danger of financial collapse began to fade. Yet the crisis had revealed something deeply troubling. The survival of the entire American financial system had depended on the actions of a single private banker. For many Americans, this realization raised an uncomfortable question. What would happen the next time a financial panic struck if no one like J.P. Morgan were there to intervene? The government intervention. Even as J.P. Morgan and his associates worked tirelessly to stabilize the banks, it became clear that private efforts alone could not solve the deeper problem. The panic of 1907 exposed a fundamental weakness in the American financial system. The government had no central authority capable of regulating banks, providing emergency liquidity, or coordinating nationwide responses to financial crises. The federal government had watched the panic unfold with growing concern. President Theodore Roosevelt and his administration recognized that widespread financial collapse could devastate the nation's economy. Factories might close, businesses might fail, and ordinary Americans could lose their life savings. Yet at the time, the government's tools were limited. There was no Federal Reserve, no national deposit insurance, and no central banking system to intervene quickly. The Treasury Department stepped in as best it could. Secretary of the Treasury George Cortelyou worked closely with Morgan to inject government funds into key banks. By making deposits in solvent institutions, the Treasury aimed to reassure the public that banks had sufficient reserves. This measure was carefully calculated. Too little money and panic would continue. too much, and it might signal that the system was in deeper trouble than anyone wanted to admit. In addition to providing liquidity, the government coordinated with New York State authorities to stabilize failing trust companies. Officials encouraged banks to collaborate, pooling resources to prevent further runs. Regulators and politicians acted as intermediaries, persuading hesitant bankers to contribute to emergency funds. Although the immediate crisis was eventually contained, the events of 1907 highlighted the need for long-term reforms. It became painfully clear that the survival of the nation's financial system could not depend solely on the judgment of a single private banker, no matter how influential. In the aftermath, discussions began in earnest about creating a centralized banking authority. Economists, politicians, and bankers debated how the country could prevent future panics. The seeds of the Federal Reserve System, which would be established in 1913, were planted in the lessons learned from the Panic of 1907. The government's intervention during the crisis was significant. It helped calm depositors and stop the panic from spreading further. But it also revealed that the United States lacked a permanent mechanism to manage financial instability. The events of 1907 became a turning point, showing that both private initiative and government oversight were necessary to safeguard the economy. In short, the Panic of 1907 was not just a financial shock, it was a wake-up call. It taught the nation that the power of banks, the responsibility of private financiers, and the authority of the federal government had to work together, or risk catastrophe. The economic damage. Even after the immediate panic of 1907 subsided, the economic consequences were both deep and widespread. The panic did not destroy the United States economy, but it left lasting scars that affected businesses, workers, and ordinary citizens alike. In the weeks following the crisis, banks and trust companies that had survived were still weakened. Many had lost significant portions of their reserves due to the sudden withdrawal of deposits. Lending slowed dramatically as banks became cautious, making it harder for businesses to borrow money to operate or expand. This sudden contraction of credit caused a ripple effect across the entire economy. Industries that depended on short-term financing, railroads, construction, and manufacturing, were particularly hard hit. Orders were cancelled, projects delayed, and wages sometimes reduced as companies struggled to maintain cash flow. Some smaller businesses could not survive the sudden tightening of credit and were forced to close. Investors who had speculated in the stock market faced heavy losses. Stocks that had been highly inflated by speculation plummeted as panic spread through the market. Wealthy financiers and ordinary investors alike lost fortunes overnight. For some, decades of accumulated savings vanished in a matter of days, fueling fear and uncertainty across the nation. Workers, too, felt the impact. Factory production slowed in some cities as companies cut back to preserve cash. Temporary layoffs became common, and wages were often reduced. Families that had already been living on thin margins were suddenly at risk of poverty. Even though the panic was short-lived, the human cost was real and immediate. Another significant consequence was the erosion of public confidence in the financial system. Ordinary citizens, having witnessed bank runs and collapsing trust companies, became wary of depositing money. The sense of security that had previously underpinned the financial system was shaken. People began demanding more oversight, stronger regulations, and assurances that their money would be safe in the future. The Panic of 1907 also had long-term implications for corporate America. Banks and trust companies became more cautious in lending, mergers slowed temporarily, and speculation was restrained for a time. Yet, at the same time, the crisis demonstrated the enormous power wielded by financiers like J.P. Morgan, whose intervention had prevented a complete collapse. It highlighted how intertwined private wealth and public stability had become. In summary, the economic damage of the Panic of 1907 extended far beyond the financial district of New York City. Businesses struggled, workers faced insecurity, investors suffered losses, and public confidence in banks and trust companies was deeply shaken. While the nation survived the crisis, the lessons learned would reshape the financial system for years to come, ultimately leading to reforms that would make the American economy stronger and more resilient. The birth of modern banking reform. The Panic of 1907 left the United States with a powerful and undeniable lesson. The nation's financial system was fragile, and relying on private bankers alone to manage crises was too risky. While J.P. Morgan had successfully coordinated the rescue of banks and trust companies, the fact that the survival of the entire economy depended on a single individual highlighted a systemic flaw. Economists, politicians, and business leaders began asking critical questions. Could the country prevent future panics? How could banks be made safer for depositors? And what role should the federal government play in ensuring economic stability? Discussions turned quickly to the idea of creating a centralized banking authority, an institution that could provide emergency liquidity, oversee banking operations, and maintain public confidence in the financial system. The lessons of 1907 became a driving force for reform. One immediate outcome was the push to establish a central reserve system. Policymakers proposed a structure that would allow selected banks to pool resources to provide emergency loans to institutions in trouble. This would ensure that a single bank's failure would not trigger a nationwide panic. Debates over the reform were intense. Some feared giving too much power to a central authority, worried it might interfere with free market principles. Others argued that without such oversight, the country would remain vulnerable to repeated financial crises. Through careful negotiation and compromise, these discussions gradually led to a legislative framework for a national banking system. The eventual result was the creation of the Federal Reserve System in 1913, 6 years after the Panic of 1907. The Federal Reserve was designed to stabilize the banking system, control the supply of money, and provide emergency funding to banks in times of crisis. It fundamentally changed the way America managed its economy. The Federal Reserve was not just a technical reform, it was a philosophical shift. The idea that the federal government should play an active role in regulating the economy and protecting ordinary citizens' deposits represented a dramatic departure from previous hands-off policies. The Panic of 1907 also influenced the development of banking regulations and trust oversight. Policymakers sought to prevent excessive speculation, encourage transparency, and ensure that banks maintain sufficient reserves. These reforms were the foundation for the modern financial safeguards that millions of Americans rely on today. In the end, the Panic of 1907 was more than a moment of crisis. It was a turning point. The chaos revealed the dangers of an unregulated, fragile financial system, and it set the stage for the creation of a modern, resilient banking framework. Thanks to the lessons learned from that turbulent autumn, the United States moved closer to a system that could withstand shocks, protect its citizens, and support the continued growth of one of the world's most powerful economies. The panic did not destroy the nation, it transformed it. It gave birth to modern banking reform and reshaped the relationship between private finance, public trust, and government oversight, laying the foundation for the American economy as we know it today. A crisis that changed the system. Finally, to conclude, the Panic of 1907 was not just another financial scare, it was a defining moment in American economic history. What began as the collapse of a single trust company quickly escalated into a nationwide panic, threatening banks, businesses, and ordinary families across the country. At the heart of the crisis was a fragile system, a financial network fueled by speculation, lightly regulated trust companies, and interconnected banks, all operating without a central authority to stabilize the economy. The sudden collapse of confidence revealed just how vulnerable the nation's wealth truly was. Yet, in the midst of chaos, decisive action by figures like J.P. Morgan demonstrated the power of private initiative. Morgan's ability to coordinate leading financiers, inject emergency funds, and calm depositors prevented a total collapse. But the panic also exposed the uncomfortable truth. The survival of the entire American economy had depended on the judgment and influence of a single private individual. The federal government, while supportive, lacked the tools to intervene effectively. Treasury deposits and coordination helped stabilize certain institutions, but it became clear that private solutions alone could not guarantee long-term financial stability. The aftermath of the crisis left its mark on businesses, workers, and everyday Americans. Banks became more cautious, lending tightened, and speculation slowed temporarily. Public confidence had been shaken, and depositors now demanded accountability and safeguards. The losses, both financial and psychological, rippled through the economy, highlighting the need for reform. Out of this turmoil emerged a new understanding of the relationship between government and finance. The lessons of 1907 directly influenced the creation of the Federal Reserve System in 1913, a centralized banking authority designed to prevent future panics, regulate money supply, and ensure the stability of American banks. Modern banking, deposit insurance, and regulatory frameworks all trace their origins back to the wake-up call of this crisis. Ultimately, the panic of 1907 was a turning point. It demonstrated both the immense power and the inherent fragility of America's financial system. It taught the nation that unregulated speculation and over-reliance on private financiers could endanger the entire economy. But it also showed that thoughtful intervention, combined with systematic reform, could build a stronger, more resilient system. The crisis did not destroy America's economy. Instead, it changed it forever, laying the groundwork for modern banking, financial oversight, and economic stability. It remains a powerful reminder that progress, even in wealth and industry, comes with risk, and that the lessons of past crises are essential to preventing future ones. In the end, the panic of 1907 was more than a financial collapse. It was a crisis that forced the United States to confront its vulnerabilities, rethink its institutions, and emerge stronger than before. It reshaped the nation's economic future, proving that sometimes the greatest lessons come from the most dangerous moments. Thank you for watching. If you found this piece of history compelling, please like this video and subscribe for more stories that shaped our world.